Hello and good morning, listeners. Welcome back to Almus Market Mornings, your daily dose of global financial update with Shikhar Garg and Jayaram Krishnamurthy. Now, folks, there has been quite an impressive downside action in oil, even with the OPEC supply cut update, primarily attributed to the surge in supply by the US as well as the growing concerns around the growth, or we must also say a softening of demand. On the other side, US economy, as we have been seeing, the bankruptcy has risen further. Now it's at levels last seen in 2010. Even the Asian markets seem to have opened lower, having some rub off from the global markets, but the Indian markets continue to perform well. So, JK, all these aside, we have a slew of data updates in these 2 days. What are your expectations from this?
Good morning, Shikhar. Yes, the next 2 days are going to be quite hectic for data analysis. But yes, just going back to yesterday, we had quite a few number of soft numbers, more from US economy and of course from Eurozone as well. And then we had something to chew upon in China also today morning. The ADP jobs report, which comes 2 days ahead of the non-farm payroll, actually surprised to the downside, coming at 1,03,000 versus 1,30,000 last month, and 1,13,000 last month, and 1,30,000 was expected for this month. And importantly, even the wage growth in the report showed a much lower increase also. And we also had another employment indicator in the form of the the unit labor cost, which came at minus 1.2% versus minus 0.9. This is for Q3, although it is old, but it because we are seeing a soft labor market, one can expect that this pressure on downward pressure on wages might be continuing, and that may be something good for the rate doves. The productivity also grew faster than initially expected. That would put more pressure on labor costs because the lesser number of workers can turn out more work. So that was the picture from US. And if you look at Eurozone, the retail sales came slightly lower than what was expected, in the poll, and they were actually down both on month and on the year-on-year basis. Now the retail sales have fallen for about 2 years in a row, and although the volumes have stabilized in recent months, it's not to a degree that we can expect an imminent revival of the Eurozone economy, at least as far as the consumption is concerned. German industrial orders also fell quite a bit. That was 3.7% minus, it was compared to a rise of 0.2% on the previous month. So again, although it is down, market did not give so much importance to it because it was for October, and we have seen the PMIs somewhat improving. And so maybe we wait for more clues and data from coming months. Then the Chinese trade data today has been one more dampener for risk, because while their export showed positive trend after being minus 6.4 last month, imports were down 0.6%. That is, after being plus last month. And when you're importing less, it means both the local demand and the demand meant for export goods is also down. So that straight away indicates that level of economic activity is going to be lower in the coming months. It's definitely a leading indicator as far as China is concerned. That's the reason why you're seeing even Australian dollar reacting lower, because Australia and China are closely related as far as trade is concerned. We did have Canada rate decision, which one more bank that kept a rate on a pause, but saying the usual line that it was not saying that the inflation was won over, and therefore they will remain alert for further hikes if necessary. But there was some relief from Bank of Japan as the deputy chief there hinted that the negative rate may be closer to ending, and central bank may be closer to putting an end to the negative rate interest rate policy. And so that is in spite of the fact that we did have a slightly lower inflation number in the Japanese economy. Now, while the softer data, normally what you would expect these softer data to do is to keep the yields down and keep the dollar down. Yes, yields were down, but not as much as one would expect. 10-year was supported at 6.10. 2-year was slightly actually higher, but it was the dollar that surprised because it was higher, particularly rising against the euro, despite the expectations on rate cuts being now as much as 80% for May and about 60% for March. But one could also explain it from the fact that market is now more inclined to think of a rate cut by ECB in March itself, and they are discounting 175 basis points of cut in European Central Bank. So that's more than what they are expecting from the Fed. So it's not surprising that euro has been under some pressure. It has been testing important technical level at 1.0770, where the 100-day moving average is around. But I think if we do see more softer data from Europe, or if the risk takes a further hit, as can be seen, the Japanese market is down 600 points. We had Dow, Nasdaq, and the S&P 500 all on the negative side, but not as much as you would make wonder. But I think it's par for the course, because we had a big rise in the recent weeks, and we are into a period of consolidation. But what worries more, as you mentioned, was the oil price fall. The Brent falling by 3.29% and the WTI falling by 3.42%. Brent is below 75 and WTI below 70. These are causes for concern, raises doubt whether market is trying to discount a deep recession for the global economy. Of course, US producing record amounts of crude is one major factor. But even with the OPEC Plus and Russia announcing their output cuts, the prices have not responded to the higher side. So that's a cause for worry. And of course, the recent data on PMI from US and also the Chinese import numbers also would not be encouraging for the bulls for the oil prices. Coming to the rupee, we did see a rare intraday selling pressure on USD-INR that was aided by flows. In fact, flows have been significant this month, already hitting close to 4 billion USD, taking the total flows for the year to 22 billion. And this is the highest amount of FI flow that we have received after 2017. In the face of such a flow, interesting that on a calendar year basis, rupee has actually weakened by nearly 0.7%. But compare it with dollar index, that has also risen almost by a similar percentage. So you can say that the USD-INR overall kept pace with the dollar index, but it avoided the big swings. Thanks to central bank's efforts, we have seen a very stable rupee weathering various global influences, and that has been a comforting factor definitely for the corporates looking to hedge themselves. This means that to see any large moves in INR on either side, we also need dollar index to move significantly from the current levels. And that is probably not going to happen this month when the market becomes less participated, definitely after FOMC. And the monetary policies also hang in balance now. I don't think FOMC is going to commit itself to any rate cuts. More quiet period for general currencies, and rupee in particularly is on the cards as far as December is concerned. Thank you.
Okay, JK, that was really good. And yes, folks, the kind of action we are observing in oil, even after OPEC Plus and US and all these updates, it seems that the market is discounting a deeper recession. And it is being also supported by the kind of softer data that we have been seeing in the name of PMIs and the Chinese trade deficit data. Other than that, we do expect the month of December, as it has always been, a bit less participative. Although after the MPC and the FOMC, and that's when the lower action will be much more visible. uh, Indian markets have already seen quite interesting flows for this month. Approximately $4 billion of flows have already been observed. But if we still have to talk about the global front, there is a slew of softer data being released on regular basis. Even the Canadian central bank went ahead with the pause decision, but the markets are already pricing in almost as 175 basis point cut by the ECB. And not just that, they are expecting them to start off even earlier than the Fed. So that's quite an interesting set of updates that the market is trying to digest or discount. That's it for today, folks. We do have RBI MPC tomorrow with much more better updates, Eurozone GDP update, and a lot many things to watch out for today and tomorrow. So we'll come back again with another round of updates. Thank you so much for listening.